Matt, where you are at BlackRock, you have the privilege of having a very wide, diverse set of investors. You know, everything from like huge scale institutional investors to me. I actually am an investor. So, what do you see? I wonder if there's differences between the institutional investors and the retail set of investors with respect to what risks they see, what they perceive, and what opportunities they perceive.
Yeah, I think it's a really interesting asset class, one, just because, and if anyone has a different example of this, I would love to know. I don't know of any other asset class that like went entirely from retail to wealth and then institutions in that direction, where things always go in the other direction historically. So one, I think that's just like an interesting point to flag. I think though the investment case is actually surprisingly similar. We can certainly debate the correlations because like correlations, like Bitcoin doesn't look like gold from a trading perspective, but like the fundamental qualities like actually really do. And there's been a lot of idiosyncratic things that have been driving Bitcoin the last couple of years, things like the election, things like expanding access to wealth via ETPs. And so I think most of our investors are thinking about this as an asset that's truly scarce, can make long-term credible commitments about its scarcity, which fiat money can just simply not do. And in a world of sort of de-dollarization and excessive debt levels, like that's a story for most investors, whether they're retail, whether they're institutional, or I should say really anyone who's directional. There's a large pocket of investors who are just trading this tactically. Probably a lot of folks in this audience, the hedge funds that are trading basis and using the ETPs as the long leg to collateralize a short futures position. But for the folks that are directional, they're generally thinking about this as a de-dollarization, long-term scarcity trade. Where are the differences in sort of the approach between them? And this is where I always find a little bit interesting. Like our internal think tank came out and said, we think 1 to 2% is like a good Bitcoin allocation for most investors who want to have that profile in their portfolio. In reality, I've seen like a much more, what I would say is like a bimodal distribution of sizes. And I'm speaking very clearly about folks who have invested. Like the majority of wealth and traditional investors are still on zero, but of the ones that have invested, direct investors can be extremely large sometimes. You'll find the direct investor who it's their entire portfolio. But speaking between like wealth and institutional, we typically see wealth on the higher end of our range, like above the top bound of our range. Typically, I would say 3-4%. I feel like a lot of them feel like they've done a lot of work and they don't want to do all that work to get to that point and put in 1%, which they feel like doesn't have a material impact on their portfolio. And then simultaneously on the other end of the spectrum, most institutions I've seen are less than 1%. They're substantially more portfolio construction focused, thinking about time varying correlations, trying to come to terms about how it fits in a portfolio context and overall portfolio efficiency improvements. But oftentimes you'll even see it. Like some like Rick Reeder, who runs multiple trillions of dollars for BlackRock, has had Bitcoin in his portfolios, multiple portfolios, in some cases fixed income denominated portfolios. And that's just because they think of it as a truly scarce asset that's going to improve portfolio Sharpe ratio, being fully aware of volatility constrained. Like it just can't be more than a 30 basis point position in those types of books. Notably, they've actually just extended to ETH too in those portfolios. I think that was public yesterday, but also again, just very small basis point positions, thinking about Sharpe optimizations, thinking about portfolio improvement with very vol constrained mandates. And so that's generally the theme I see is more portfolio construction focused, smaller position sizes.